Greetings, salutations, howdy, however you say it in your neck of the woods, allowed me to welcome you to another episode of The Art of Reading Price Action. Again, welcome to another episode of The Art of Reading Price Action. My name is Timothy Lee Rogers Sr., if you don't know who I am. And in this episode of The Art of Reading Price Action, we will be discussing the open, high, low, and close. Well, Tim, what is the open, high, low, and close? Well, I'm glad you asked that question, because without further ado, let us get right into it. Before we get started, if you'd like to download the slides, there is a link in the description down there somewhere where you can download the slides for absolutely free. And if you want to join the $24.99 mentorship so that where you get more one-on-one time with yours truly, there's a join button around here somewhere. Click it. Now, let's get into it. The Art of Reading Price Action. What's the open, high, low, and close? Well, Tim, that's super elementary. What are you talking about? The open, high, low, and close. First of all, the type of, you can get the open, high, low, and close off of a bar stick chart or a candlestick chart. The chart that I prefer to use is the candlestick chart. They're easier on the eyes than the bar charts, but the candlestick chart is a type of chart that displays the open, high, low, and closing prices for a specific period of time. You'll see a lot of time with OHLC, right? And it displays it in the form of Japanese candlesticks. That's what those little things are. You notice the candles, that's what they are, right? These right here. This is a crude depiction of Japanese candlesticks made by yours truly. You want to get in the habit of saying up close candles and down close candles. But why? Because platforms let you change the color of the candles, and all up close candles won't be green, depending on who set up the platform. The default is green and red, but you can change them. And down close candles won't always be red. So you want to focus on saying up close and down close. Now, one of the mentees reached out and was like, hey, I'm a visual learner. I like to see the visuals of what you're talking about. And I'm listening. Look at the beautiful chartage. Look at the beautiful slidage, should I say. Look at the slidage, it's beautiful. Right? So we're gonna revisit the candlesticks real quick, because the candlesticks is a big part of reading price. Why do I say that? Because the candlesticks show you a specific period of time. So no matter what period of time you're looking at, yep, you guessed it, there's going to be a candlestick for that. Remember, there's an app for that. There's a candlestick for that. Now, you have the open on an up close candle. You have the high. You have the low. And you have the close. Okay? You have the open on a down close candle. It's at the top of the body. See the difference? The bottom of the body for the up close, the top of the body for the down close. Right? You got the high, you got the low, and you got the close. The only difference in between the two is the open and the close. On down close, we close down or lower than we open. On the up close, we closed up or higher than we open. The top wick shows you the highest point of the top wick, shows you the high of the period. The lowest point of the bottom wick shows you the low of the period. Some people call the bottom wick a shadow. Some people call it a tail. I just say wick, top wick, bottom wick. So that's the candlestick. That's how the open, high, low, and close looks on the candlestick itself. Follow me? Got it? Tracking? Everybody good? Okay. Everybody good. What's the importance of the open, high, low, and close? Well, the open, high, low, and close gives you 4 major data points. What are they? the open, high, low, and close, right? The open is the first agreed upon price for that period. That's very important. That's very important to know. When you got buyers and you got sellers, what is the very first price that they agreed on was a fair price for this asset? That's the open. The high, that is the highest agreed upon price for that period. This is the most anybody was willing to pay for this asset during this span of time. The low is the opposite. It's the cheapest, the lowest agreed upon price for that period. This was the absolute lowest during this period that anybody was willing to pay or anybody was willing to sell their asset at. That's the lowest price that was agreed upon. The close. A lot of people see the close as the most important price out of all four because the close is the last agreed upon price for that period. This is the price at the end of all of the hustling, bustling, the back and forth, the pulling and the pulling and the pushing and the pushing, that they said, okay, we can agree that this is the final fair price of this for this period of time, right? Those are the four major data points of the open, high, low, and close. It's the name itself, the open, the high, the low, and the close of the period. Now, not only does the candlesticks, the open, high, low, and close tell you about price, agreed upon price, it can also show you sentiment. This is very important. The open, high, low, and close can also show you sentiment of the market at that particular period of time, right? So it can show increasing or decreasing momentum, right? When the open and close are far apart, like this big candle right here, when the open and close are far apart, it shows strong momentum. When the open and close are closer together, it shows indecision or weak momentum, right? Like a candle right there, when the open and close are really close, or especially when it's in the exact same spot. When it's in the exact same spot, here's your $10 drinking word for the day. It's called a doji candle. I think you spell it D-O-J-I. Don't quote me on that. But if the open and the close is in the exact same price on a candle, it's called a doji. So you'll have a wick, no matter how long the wick is, on the top and the bottom, and then it'll be one line in the middle. It can also help in assessing volatility, right? The difference between the high and the low shows the full range of the period, right? So if it's a big difference between, and you can visually look at it, or if you are a super genius mathematician, you can pull out your calculator and you can subtract the low from the high. And if you come out with a big number, it's potentially a lot of volatility because it was a wide range between the high and the low. So the difference between the high and the low gives you the full range of that period, and that can show you, is there any volatility? Now, let's look at a few examples of the candles. This ain't the all-inclusive list of the candles. Actually, I think my financial advisor told me there's like 13 different variations of candles. Don't quote me on that. Anyway, a big candle like this, in this case, it's a big up-close candle. Looking at this candle from where it opened to where it closed, it shows strong momentum on the buying side because it's an up close candle showing it opened down here and closed really, really near the high of the period. That's showing strong momentum a lot. It's a very big range between the highest high and the lowest low. So that indicates possible high volatility, right? And it also indicates a possible trend continuation, meaning you got a lot of momentum, a lot of volatility. The trend can potentially keep going based off of looking at that candle. Now, looking at a candle like this right here, the next one over, the little green one in the middle at the top, in the top middle. This type of candle is showing weakening momentum on the buying side and then a strong shift in momentum on the selling side. Why? Because at one point, the buying had went all the way up to here, and then the selling pushed the price all the way back down to here, and the agreed upon price, you got a longer top wick than you do a bottom wick and body. It's still a green candle, but it's showing that the buying momentum is slowing down and is shifting to a stronger selling momentum, right? And it can indicate a possible retracement because you see the selling momentum is stepping up, the buying momentum is slowing down, and it's a possible retracement coming in the near future. Now, this green candle to the top right, this indicates indecision, right? And it's a pretty nice size candle from wick to wick, wick high to wick low. So it's a pretty decent, it's not as big as this difference, but it's a pretty decent. So I'd say that's relatively moderate volatility can be expected during a time like this when this candle was made. But this is indecision because it's not giving you any indication of who's really in charge, right? We opened in one spot and we closed almost in the exact same spot. So the price that was agreed upon for buying and selling ended up being right in the same spot by the end of the period. So you don't know if it's going up or down. You don't know what to expect coming forward. You need more information after seeing a candle like this. Now, let's look at this. You have a strong momentum to the selling side. We're at the bottom left. You got a strong momentum to the selling side. It's not as big as this candle. It's not as big as that candle. So I say it's moderate volatility. And it also shows a possible trend continuation because we opened near the high and we closed very near the low. Possible trend continuation is all of them is showing you some type of sentiment. Okay, this candle here, weakening of the selling momentum, but a strong shift to the buying momentum. Because again, at some point in time, price had sold all the way down to here, but there was a strong shift in buying momentum that pushed it up to close in the top quarter of the entire candle. So it's a red candle, but that's a lot of strong buying momentum, right? And it's a very large candle. And so it's a big difference between the high and the low. So that's high volatility. And so this also indicates a possible retracement because it was a red candle. We had sold down. So this would be a possible retracement following to the next candle, the next period, the possible retracement. Okay. And like before, this is indecision, but in this case is low volatility, very small range. Right, very small range, same as this indecision, but this one here is an example of low volatility, a very small range candle. Now, tracking, you still with me? Still cooking with Crisco? All right, let's move on. Now, the significance of the open, high, low, and close is every element of price action has an open, high, low, and close. All elements of price action have an open, high, low, and close. It can be years. It can be months. It can be weeks, days, sessions, hours, minutes, seconds. Every single candle, every single time period has an open, high, low, and close. You can track everything by the open, high, low, and close. And these data points are very important because the algorithm will refer to the open, high, low, and close of all previous periods. It can be the prior minute to the prior session to the prior day to the all elements of price have an open, high, low, and close, and the algorithm will refer to these data points to use as a bridge building mechanism to get to Picasso's house. Remember that, all elements. Now, let's get to the homework. Yep, this episode we will have homework. And what is your homework? Your homework is to go back through price and mark out the open, high, low, and close for each day, right? Also, once you mark the open, high, low, and close for the day, I want you to mark out the open, high, low, and close for the New York session on the 15-minute chart, right? The New York session runs from 9:30 a.m. to 4 p.m. Eastern Standard Time. And once you do, I want you to do it for each day, right? And once you mark out the open, high, low, and close for the day, then mark out the open, high, low, and close for the New York session. I want you to take notes on how price reacts to the 4 major data points during each day and each week, right? And I want you to use the ES chart, the March contract, so that'll be ESH 2024 on TradingView. And I want you to go back for 1 month in time. And I want you to do every day from 1 month back to the present. I want you to mark out an open, high, low, and close for the day, on a daily candle. And then I want you to go into a 15-minute chart on that day where you marked out the open, high, low, and close, and mark out the open, high, low, and close of the New York session. And then take notes on how price reacted to those levels for that day. Save it as a screenshot. TradingView lets you save it as a screenshot. Don't worry, we're going to go through this really quickly after this. Then do Monday, then do Tuesday, then Wednesday, Thursday, and Friday. You're going to save all of them as separate screenshots. And then once you got that week complete, I want you to look at that week and see how price reacted to the open, high, low, and close for every day through the entire week. Because if you have the open for Monday, that's the open for the week. If you have the close for Friday, that's the close for the week. Whichever day in between had the highest point, that's the high for the week. Whichever day in between had the lowest point, that's the low for the week. So now you got the open, high, low, and close for the week. And you can see how price reacted through the entire week, each day. Just take notes on all of that. Now, let's move over to a chart, and I'll show you exactly what I mean. We're just going to go through an example for one day. Okay, here we are on the ES chart. Again, for TradingView, it's ESH 2024. You can see the ticker symbol up here in the top left corner. So what you want to do, you want to go to the daily chart first. Type in 1D. Just type 1D on the keyboard and press enter, and it'll pull up a daily chart. Now, we have daily chart showing. And so here we are. And this is Friday, Thursday, Wednesday, Tuesday, Monday, right? But you're going to go back 1 month. You're going to start back 1 month up until the day. So today is February the 8th. Today is March the 8th. So you'll go all the way back to February 8th. That's a Thursday. Don't want to start on a Thursday. So we'll just start that Monday on February 12th. So from February 12th up into today. So we'll start out on each day, get the line. I like to use the trend line tool. You can use the raise, whatever you want to use. But just for this, to mark the trend line tools, if you have your magnet on, it will snap to the point where you want it. If you hold shift, it'll keep the line straight. You just want to move it over to the next candle so that it doesn't go too far when you're looking at. So you move to the next candle, boom, right? That's the high. Then you want to mark out, here we go, that's the open. Okay, now that we have that, I'm going to put a box around this to make it easy for me to find it when I drop down. This isn't necessary. You don't have to do this part. I'm just doing this so it'll be easy for me to find when I drop down. You'll see the chart shifts around. Now, That's the area right there. Okay, now I don't need that box anymore. Now, these are 15-minute candles, right? And this is the open of that day. This is the high of that day. This is the close of that day. And this is the low of that day. I typed close twice. So now, this is a 15-minute chart. You can type 15 to get here. Just type 15 on the screen and press interval. Because see, if you start typing, it says change interval. Type 15 for minutes. Whatever you type, if you don't type anything after the numbers, it's going to look for the minutes. If you want to say a day, you hit the letter D. Right? If you want to say an hour, you can hit H after the 1 or just type 60. And those 60 minutes is an hour. Quick little tip if you don't know that. Now, you want to find 9:30. You don't have to put a vertical line. Just to make it easy to find, you want to find the 9:30. That's the 9:30 candle right there. Then you want to find the 4 p.m. close. Because we're looking at the New York session. Right. And that's the 4 p.m. close. And you notice the day goes all the way over here. Day goes all the way over. This is the last candle of the day right there. And this was the lowest candle of that session. This is the last candle of the day for the futures day. But we're looking at the New York session. So in the New York session, we're going to get a different color. This is the first candle there at no, that's 9:15. This is the first candle here, 9:30. So this is the open because it's a green candle. So the open is on the bottom. Right, open is on the bottom. Right, then we're gonna go is the high is already marked out. So let's do this. We'll move this back to that candle, and then we will. I just held control and clicked on a spot that didn't have a circle on it, and to copy it. That's the high. Let's do this right here. We're gonna put NY on there. High NY. Open NY is for New York. Open NY. And you can, like I said, you can color it however you want. Hold control. Go into a spot where you're not on a circle node. I copied both unintentionally, but that'll work out. Then this is the lowest spot of New York. That's 4 o'clock, so it's closed. So this is the lowest spot of New York right here, because it closes at 4. Right? It closes at 4. So the 4 o'clock candle is not a part of it. It closes at 4. Low for New York. Stretch it out some so you can see that. And then the 4 o'clock. This is the last candle of the New York session because it closes at 4. So we're going to get that closing price on that candle at 345 right there. That 345 candle. And it closed there. So that's the close. New York close right there. And when you start comparing your weekly charts, you can feel free to extend your time through the next day so you can see how price reacts to it. Right? If price comes back to that point. Like extend out the low. Let's extend out the low throughout the week and see right there. Price first encounters it there at that point on Thursday. Encountered the low. At that point, you can extend it out through the week to see how price reacts to it. Or you can just use rays. If you use a ray, when you click a ray, it automatically extends through the end of the chart for you. So that's how you mark it out. And then, so now this right here, you can annotate any kind of note that you want to annotate there. Right? We'll just put a note. Monday's price. Just making a simple little note. Whatever notes you want to take and put on the screen, put it there, and then you come to the little camera in the top right corner over here by the publish button and click that and hit download image. When you hit download image, the image downloads. It goes to my download folder automatically, and there's the image that I just downloaded. See, I open it up in my downloads folder. There's the image. There's the actual screen. I'll show you the difference by taking the stuff off the chart. So when I take all the stuff off the chart, now you got the naked chart, and there's the image. That's how you save your homework to, add to your journal folder. Make a folder on your desk, call it journal, whatever you want to call it, and save your homework in there. And for those who are part of the paid mentorship, we will be reviewing the homework and answering any questions pertaining to the homework Wednesday at 7 p.m. Eastern Standard Time. Also, this Sunday is the second Sunday of March, which would be March the 10th, and we will have our very first monthly Q&A session with those that's in the paid mentorship. And with that, that brings us to the end of another episode of The Art of Reading Price Action. It's your boy, Aranya Grande, aka Big Spider. Until the next time, man, y'all be safe out here in these trade streets. I'm gone. Yeah.